Hello and welcome to Insight AI Brief Set Thai. Today we're going to talk about the stock TU, which stands for Thai Union Group. But before we get started, please don't forget to follow, like, and share to support our team. Our mission with this deep dive is to analyze and summarize the very latest insights on Thai Union. We want to shed light on its recent performance, its bold future strategies, what analysts are saying about its stock price targets, its overall financial stability, and, its long-term investment appeal. We're drawing directly from the most current reports and analyst briefings, so you're getting a truly up-to-date and comprehensive picture designed specifically for you.
That's right. And Thai Union Group isn't just another company. It's a global powerhouse in the food industry. It's a name many might recognize from their grocery store shelves, but maybe fewer people truly understand the intricate workings that underpin its market position and its resilience. At its core, their business spans everything from frozen and canned, ready-to-eat seafood to a significant and, frankly, growing pet food segment, alongside various other related ventures. Today, our goal is to move beyond just the surface-level headlines. We're going to dive deep into the specific numbers and the strategic moves they're making to really grasp what's driving this global giant. It's about much more than just their products. It's about their financial health, their ambitious vision for the future, and how they're navigating an increasingly complex global market.
Okay, let's unpack this then. Starting with their latest quarterly performance, specifically for Q1 2068. Then maybe just a quick clarification for our international listeners. 2068 refers to the Thai Buddhist calendar year, so we're talking about Q1 2025 in the Gregorian calendar. Some reports might just call it Q1 25. Sure. So let's begin with the big picture, their revenue and net profit figures. Thai Union reported a net profit of THB 1,019 million for the quarter. Now, at first glance, that number shows declines both year over year, down 11.61%, and quarter over quarter, a drop of 15.97%. That seems like a tough quarter on the face of it.
Indeed, those are significant percentage drops when you just look at the headline number. However, here's where it gets really interesting and where we need to dissect the numbers a bit. Despite these declines, that reported net profit of THB 1,019 million was actually higher than what many analysts had forecast, and by a significant margin. Kingsford Research, for example, had forecast THB 882 million, so Thai Union beat that by a solid 16%. And when we look at the broader BB consensus, which typically aggregates forecasts from various brokerage firms, mostly from Bloomberg, here their estimate was THB 697 million. Thai Union's actual profit was a remarkable 42% higher than that consensus. So yes, while the year-on-year picture was down, they still managed to surprise the market quite positively.
Wow, okay, that is a huge beat, especially against the consensus. But if the top-line numbers, the revenue, were down, what was the crucial reason for this surprising outperformance? What's the real takeaway for an investor looking at TU's core business performance here?
That's the critical question, yeah. And it really highlights the importance of always dissecting these headline numbers, The primary reason for this positive surprise was a specific one-time non-cash gain of THB 381 million. This gain resulted from the reversal of deferred income tax liabilities, specifically related to their investment in Avanti Feeds Limited, or AFL. That's an Indian-based shrimp feed and processed shrimp producer. So this Q1 profit beat isn't really a reflection of, say, significantly improved operational strength or higher sales volume. It's more of a financial adjustment.
Okay. A non-cash gain. So tell us more about this Avanti restructuring then. How does a tax position reversal lead to such a significant gain if, as you say, their ownership didn't even change? Seems a bit counterintuitive.
It is a bit technical, I admit, but let's break it down simply. This wasn't a change in their core business or, sale of assets. It was basically an internal transfer of shares within the same corporate group. And it was implemented purely for compliance reasons, specific changes in Indian foreign exchange laws and regulations. Crucially, Thai Union's effective ownership in Avanti Feeds remained unchanged at 24.21%, and there was no impact whatsoever on Avanti's day-to-day operations. Now, before this restructuring, Thai Union had recognized what's called a deferred tax liability related to its investment in AFL. Think of it like this. They had an anticipated future tax bill booked on this investment, kind of like a pre-booked future expense. This happened because the accounting value of their investment was lower than its tax basis, how it was valued for tax purposes. But after this internal restructuring, the situation flipped. The way their investment was now valued for tax purposes actually exceeded its accounting value. This effectively created a potential future tax benefit instead of an obligation.
As a result, the existing deferred tax liability no longer accurately reflected their tax position, and so it was reversed. That reversal then flowed through the profit and loss statement, resulting in that THB 381 million non-cash positive impact for the quarter ending March 2025. So, yeah, It's essentially a cleanup of the books due to regulatory changes, not really an operational windfall.
Right, got it. So if we strip away that non-cash gain, how does the profit look then? What does this all mean for Thai Union's underlying performance, without that special item boosting the numbers?
Well, if we exclude that THB 381 million non-cash item, the underlying profit would actually have been lower than Kingsford's initial expectations. This really underscores that the core business faced some significant headwinds during the quarter. However, it's also important to add another layer of nuance here. Thai Union is currently undergoing a massive internal overhaul with their Strategy 2030.
Mm.
This involves significant transformation costs. Now, if we look at their net profit, excluding these specific non-recurring transformation costs, the figure stood at THB 1,317 million. This actually shows an 8.9% increase year over year. This adjustment gives us a clearer, perhaps more nuanced view of their core business health. It helps distinguish between one-off financial boosts, strategic investments for the future, and everyday operational performance. It suggests that once these transformation costs normalize, the underlying profitability of their operations could actually be quite robust.
Okay, that distinction between the one-time gain, the ongoing transformation costs, and the core operational profit is really helpful for understanding the true picture here. Now shifting to revenue. Their sales and services revenue for the quarter came in at THB 29,789 million. What were the key pressures leading to those significant declines? Down 10.33% year over year and 15.11% quarter over quarter. That's quite a drop.
Yes, there were indeed several key pressures on revenue this quarter. It paints a challenging global demand picture, really. First, we saw reduced demand in crucial international markets, particularly the U.S. and Europe, which are major customers for Thai Union. Second, negative seasonal factors played a significant role, particularly impacting their frozen business segment, which typically sees weaker sales in the first quarter anyway. And third, the stronger Thai baht had an adverse effect on financial translation.
Ah, the currency effect.
Exactly. When Thai Union's significant international sales, denominated in foreign currencies like the euro or US dollar, are converted back into Thai baht for reporting. A stronger baht means those sales values appear lower, even if the underlying foreign currency sales were stable. It's a constant currency headwind that international companies like this face.
Right. And what's fascinating here is the geographical breakdown you mentioned. Where were these sales declines most pronounced, and were there any areas that showed some resilience?
Geographically, the picture is quite varied, and it tells an important story, I think. Sales in the Middle East, for instance, dropped sharply by 47.2% year over year.
Wow, nearly half.
Yeah, but this wasn't just a general slowdown. It was largely because they had unusually high demand in the previous year, which created a very, very challenging base for comparison this time around. Europe also saw a significant decrease, down 17.5% year over year. The U.S. and Canada, while still contributing a substantial 40.2% of total sales, so still very important, experienced a decrease of 6.6% year over year. Any softness there is definitely noteworthy for them. On a brighter note, domestic sales within Thailand actually saw a slight rise of 2.2% year over year.
Okay, so some stability at home.
Exactly. It indicates some resilience and stable demand in their home market amidst these broader global headwinds.
Okay. Moving on to profitability metrics and cost management then. How did their gross profit margin, or GPM, perform? I understand it was actually quite strong, even setting a record for Q1.
You're absolutely right. Thai Union achieved a very strong gross profit margin of 18.84% in Q1 2068. Which was indeed a record for a first quarter. This is really a testament to their cost control and their product mix strategy. It shows a healthy improvement from 17.28% in Q1 2067 and 18.68% in Q4 2067. Now, this improvement was largely driven by a higher proportion of sales coming from the pet food segment, which, as we'll probably discuss more, consistently carries higher margins. So it's a positive indicator of their ability to manage raw material costs and optimize their product portfolio, even in a challenging sales environment.
Right. But I imagine managing overall expenses wasn't quite as straightforward, especially with those sales pressures and the ongoing strategic initiatives you mentioned. What about their selling, general, and administrative, or SG&A, expenses?
Yes. Despite the good GPM, their SG&A expenses became a notable factor, putting some pressure on the bottom line. The SG&A to revenue ratio actually increased both year over year and quarter over quarter. This was primarily due to higher marketing costs, as they push their brands in competitive markets, and crucially, increased spending on those transformation initiatives we mentioned, like Project Tailwind. These are definitely long-term investments, but they do weigh on current earnings. So if we connect this back to that normal profit figure we discussed earlier, meaning profit excluding that special tax reversal and accounting for these higher costs, it's still at just THB 612 million. This was significantly weaker, down 31.37% year over year and a substantial 44.09% quarter over quarter. It really underscores the underlying operational challenges they faced in the quarter, before that one-time tax gain kind of buffered the headline number.
Get context makes it much clearer, thanks. Let's delve into the performance by business segment in a bit more detail then. We heard the pet food segment was a strong performer. What were the specific figures there, and why is this segment so crucial for them?
Absolutely. The pet food segment continues to be a standout performer and, frankly, a crucial growth engine for Thai Union. It reported sales of THB 4,174 million that showed a healthy 5.5% year-over-year growth. And importantly, it maintained an excellent gross profit margin of 24.5%. This segment's consistent strength and those higher margins are key drivers for the overall company's improved GPM. It acts as a valuable buffer against softer demand in other areas. It reflects, I think, a growing global market for pet care products and Thai Union's strong position within it.
Okay. And how about the processed seafood segment? That's a huge part of their traditional business, right? How did it fare with those market pressures we talked about?
Right, processed seafood, think canned tuna, sardines, that kind of thing,
Right.
saw sales of THB 14,762 million, which was down 14.0% year over year. As we touched on, there were specific reasons for this decline. Remember that unusually high demand in the Middle East last year. That created a high base. Plus, there were reduced private label orders from Europe. Apparently, customers there slowed purchases due to rising fish prices.
Ah, the price sensitivity kicking in.
Exactly. So those factors combined put pressure on sales volume. However, despite these challenges, the gross profit margin for this segment remained quite good at 19.4%, which demonstrates their ability to manage raw material costs and operational efficiencies even with lower sales. It's a sign of disciplined management, I'd say.
And the frozen seafood segment, what were the dynamics there, especially with those U.S. shrimp prices you mentioned earlier?
Sales for the frozen seafood segment came in at THB 8,441 million, down 12.2% year over year. And yeah, this decline was specifically attributed to higher U.S. shrimp prices. When prices rise significantly like that, it can slow down sales as consumers or distributors pull back, maybe wait for better pricing or look for alternatives. However, there's good news for this segment's profitability. Its gross profit margin actually improved to 12.4% in Q1 2068, up from 11.8% year over year.
Oh, interesting. So margins up even though sales were down.
Exactly. It suggests effective cost management. Perhaps they focused on higher value products within the segment, or maybe they had successful negotiation strategies despite the higher raw material costs.
Okay. Lastly, tell us about the value-added and others segment. It seems to have had a bit of a mixed performance, sales down but volume up. What's going on there?
Yes, the value-added and other segment reported sales of THB 2,412 million, which is down 3.1% year over year. This decrease was primarily due to lower selling prices across all subsegments and maybe reduced sales from branded customers who might be destocking inventory. However, what's quite significant here, and a very positive sign for the future, I think, is the volume growth. This segment saw a substantial 13.9% year-over-year volume increase, and that marks the third consecutive quarter of year-over-year volume growth for them.
Third quarter. So there's some real momentum there. What's driving it?
The drivers seem to be stronger domestic demand for the byproduct segment that includes things like fish oil and protein, often high-value ingredients, and also increased demand for the value-added segment itself from key markets like the U.S. and Europe. The gross profit margin for this segment did decline slightly to 27.9% in Q1, mainly due to a high base in Q1 last year, and maybe slightly lower margins within the value-added subsegment itself. But that underlying volume growth is crucial. It indicates healthy demand for their innovative, higher-value offerings.
It really sounds like raw material costs and foreign exchange rates were also big factors impacting the entire business this quarter. How did raw material costs play out, especially with such diverse seafood products?
Oh, definitely. Raw material costs played a significant role and added to the complexity of the quarter, no doubt. Q1 2068 saw surging salmon prices. That's partly attributable to seasonality costs. Salmon prices often peak during certain times of the year due to spawning cycles and things like that. Tuna prices were also notably higher. That was partly due to the lingering effects of the La Niña weather pattern, which can disrupt ocean currents and impact fishing grounds, leading to lower catch rates. This, in turn, led to a kind of wait-and-see approach from customers. They held back on purchases, maybe hoping for prices to stabilize, which further impacted demand and sales volumes. and shrimp prices. They continue to remain stubbornly high due to increased global demand. So these fluctuating and often rising raw material costs put continuous pressure on Thai Union's profitability. They need to manage these input costs while staying competitive on their selling prices. It's a constant balancing act.
And the foreign exchange environment. We know the Thai baht has been strong, but how does that specifically affect a global company like Thai Union with so much international business?
That's correct. The Thai baht appreciated year over year against all key currencies during the quarter. And while a strong domestic currency can be good for imports, it creates a significant headwind for a company like Thai Union that earns a large portion of its revenue in foreign currencies. Notably, the euro depreciated by 7.8% year over year against the baht, and the British pound by 5.5% year over year.
Ouch.
Yeah. It means that when sales generated in Europe, or the UK for instance, were converted back into Thai baht for financial reporting, their value appeared significantly lower. So even if the underlying sales in euros were stable, the reported revenue in Thai baht would show a decline purely because of this adverse financial translation effect. A challenging environment to navigate for sure.
So, okay, that's the current snapshot, a company navigating some significant headwinds, from fluctuating demand and currency challenges to rising input costs. But what about the path forward? How is Thai Union, this, global giant, planning to not just survive, but truly thrive in this complex environment? Let's unpack their strategic blueprint for the future.
You've hit on the core of their strategy, exactly. Thai Union has laid out a clear and frankly ambitious new roadmap called Strategy 2030. This isn't just a set of vague goals. It's a comprehensive plan aimed at driving significant, sustainable growth and establishing the company as a truly global leader in what they term food and health nutrition from the sea. The from the sea part is key, emphasizing their origins and their commitment to sustainable seafood. But that health nutrition bit really expands their vision far beyond just, say, canned tuna. Its core focus is two-pronged. First, strengthening the main businesses they already operate in, making them more efficient, more profitable. And second, investing strategically for long-term growth in high-potential areas like protein alternatives, health products, and maybe new geographical markets. To achieve this, they're committed to a deep internal organizational transformation, aiming for greater agility, efficiency, and speed across all operations. It's about building a leaner, more responsive company.
Okay, Strategy 2030. And part of that, I think, is Project Tailwind. This sounds like a big internal initiative. What exactly is Project Tailwind, and how does it fit into this broader strategy?
Right. Project Tailwind is a key and very tangible part of their strategic transformation. It's specifically focused on the pet care segment, which, as we discussed, is a high-growth, high-margin area for them. It's designed to accelerate growth in this high-potential business, and it has a very clear, measurable goal, achieving annual savings of approximately USD 40 million.
40 million US dollars. That's significant savings.
It is. And it's not just about cutting costs indiscriminately. It's about optimizing their entire pet care value chain to make it more competitive and profitable. They're tackling this from several angles. In terms of procurement, phases 1 and 2 of this project are already complete. This covered optimizing spending on areas like MRO maintenance, repair, and operations. Basically everything needed to keep factories running, from spare parts to cleaning supplies. They also optimized ocean freight costs, a major expense, obviously in flexible packaging, like the pouches for pet food. Phase 3, starting next quarter, will focus on capability building within their procurement teams, making sure they have the skills and tools to continuously find efficiencies. And they've already completed supplier negotiations for other key categories, like secondary packaging, pouches, and poultry, trying to lock in better rates. For commercial aspects, Project Tailwind involves moving beyond just taking orders. It's about a much more proactive sales approach, with in-depth customer portfolio analysis. This means really understanding exactly what their customers need, anticipating market trends, and strategically positioning their products to maximize sales. On the manufacturing side, they're embracing technology, transitioning from manual to algorithm-based manpower planning.
Algorithm-based manpower planning, so using data and AI.
Exactly. Using data and AI to optimize staffing levels, reduce waste, and improve production efficiency on the factory floor. It's a significant step forward in operational intelligence. And across operations in general, they're making substantial investments in high-caliber talent across their ambient, frozen, and pet care businesses, bringing in the best people to drive change. Crucially, they're also revamping 3 core business processes group-wide. This could be anything from order to cash, procure to pay, or their product development lifecycle. to basically streamline everything and ensure consistent, efficient operations across their diverse global footprint. It's a truly holistic approach.
That sounds incredibly comprehensive. Wow. Beyond these internal efficiency drives, though, what new and exciting products are in the pipeline? It's always interesting to see how these big companies innovate.
Yeah, innovation is definitely a strong focus, and we're seeing them push boundaries both in flavor and category. For instance, on the flavor front, they've introduced Chicken of the Sea's new wild-caught light tuna with ghost pepper.
Ghost pepper tuna. That sounds intense.
It does, but it's a strategic move, right? Tapping into consumer demand for bolder, spicier flavors and differentiating their traditional products. And in Europe, there's a fascinating collaboration between King Oscar, one of their premium brands, and Goldfisk.no. They're introducing spreadable mackerel and pizza and taco flavors in Norway.
Spreadable mackerel. Pizza flavor. Okay, they're definitely experimenting.
Right. It shows a localized approach to innovation, adapting products to specific regional tastes and meal occasions. Beyond just new flavors, they're also looking at significant category expansion. They have plans to move into the chunk and paid pet food category in 2025. This expands their offering beyond traditional kibble or canned pet food, catering to diverse pet preferences and further growing that high-margin pet care portfolio.
These examples show a company that's constantly adapting its product portfolio. And looking at the even bigger picture, Thai Union is also proactively addressing global supply chain resilience and tariff preparedness, which is, let's face it, a major concern for any international company today. There's significant uncertainty surrounding potential U.S. customs tariffs, especially given the history of former President Trump's trade policies. And the USA accounts for approximately 38% of Thai Union's revenue, making this a crucial and sensitive area for them.
38%, yeah, that's a huge exposure. So what are they doing?
Well, Thai Union has anticipated these potential tax changes and prepared by stocking a significant 4-6 months of inventory in the U.S. 4 to 6 months. That's quite a buffer.
It is. Think of it like stocking your pantry before a big storm. They're ensuring they have enough product already in the market to mitigate short-term risks if tariffs were suddenly imposed. Furthermore, they are leveraging their extensive global production footprint. This is a massive competitive advantage for them. They have 15 production bases spread across 13 countries, including strategic locations like Ghana, Seychelles, Poland, the USA itself, and Vietnam. This diversification helps minimize the impact of potential tariff increases. It gives them flexibility to shift production or source from different regions to avoid or lessen tariff burdens. It's strong, proactive risk management.
That's a smart move, definitely, to preempt potential trade disruptions. What about the broader logistics market, though? Especially with recent issues like the Red Sea situation. Did that impact their operations?
Well, despite significant headwinds like the Red Sea situation, which has indeed led to carriers diverting vessels and continues to impact global shipping and new U.S. tariffs on Chinese imports, disrupting supply chains. Freight rates actually fell year over year in Q1 2025. And crucially, there was no direct impact on Thai Union's operations from these specific disruptions.
Really? How did they manage that?
It isn't just luck, no. It's a testament to their robust and adaptable supply chain strategy. Their solutions include maintaining FOB, or free on board, contracts that transfers some risk to the buyer once goods are loaded. They also engage in proactive cost-sharing agreements with partners, rigorous pricing negotiations, and diligent inventory management, making sure they have what they need where they need it. It shows a sophisticated operational framework designed to withstand these external shocks.
Okay, now this is where it gets really interesting for me. Thai Union has made some incredibly significant moves in sustainability. Tell us about the Blue Loan. This sounds like more than just good PR.
The Blue Loan is indeed a landmark achievement for Thai Union, yeah. And it's a powerful example of their commitment to sustainability being integrated right into their financial strategy. They secured USD 150 million, that's about THB 5,000 million, from the Asian Development Bank, the ADB, and its financial partners. This is incredibly significant because it's the first Blue Loan that's a specific type of loan for financing marine-related sustainable activities provided by commercial banks to a seafood company in Thailand. Its existence signals a new era, potentially.
The first one in Thailand for seafood. Wow.
Exactly. And its purpose is very specific, directly aligning with Thai Union's ambitious Sea Change 2030 sustainability strategy. It's earmarked to upgrade sustainable farm shrimp sourcing in Thailand. This means investing in practices that reduce environmental impact, improve water quality, ensure responsible feed management, and promote better labor practices in the shrimp farms they source from, elevating the entire supply chain.
That's impressive, both the amount and the specific focus on shrimp farming. What's the broader impact of this blue loan and their Sea Change 2030 strategy beyond just shrimp?
The broader impact is quite substantial, yeah. It extends far beyond their immediate operations. The loan itself directly supports UN Sustainable Development Goal 14, which focuses specifically on life below water, protecting oceans, seas, marine resources. It also actively promotes climate-resilient aquaculture farming practices better equipped for climate change impacts, which is key for their net zero by 2050 goal. Nationally and internationally, this initiative contributes to Thailand's climate targets and aligns perfectly with ADB Strategy 2030, particularly on climate action and rural development. Furthermore, Thai Union is deeply committed to GSSI standards, the Global Sustainable Seafood Initiative. This includes adherence to rigorous certifications like ASC, Aquaculture Stewardship Council, and BAP, Best Aquaculture Practices. And they actively source from AIP's aquaculture improvement projects, which are collaborative efforts moving farms towards sustainability certification. It shows a deep-rooted and externally validated commitment.
It sounds very thorough. Beyond the blue loan, then, what are Thai Union's broader ESG initiatives? Environmental, social, governance. How are they performing there? Are these efforts truly making a difference?
Their commitment to ESG is truly comprehensive and seems deeply integrated into their business, not just bolted on. On the environmental front, huge emphasis on responsible raw material sourcing, making sure fish come from well-managed, sustainable sources. They conduct comprehensive greenhouse gas accounting, which is a massive undertaking. And critically, this includes Scope 3 emissions.
Scoop 3, remind us what that covers again.
Scope 3 covers all the indirect emissions in a company's value chain upstream and downstream, everything from their suppliers' emissions to the end use of their products. It's the hardest to track, but shows a genuine commitment to understanding their full carbon footprint. They've also committed to the Science-Based Targets Initiative, aligning their reduction targets with climate science for the Paris Agreement goals. And they have a clear target to reduce food loss by 50% by 2068, tackling waste. Socially, Thai Union has a serious, well-documented commitment to addressing human rights abuses and eliminating illegal labor in the global fishing industry. This has been a huge challenge for this sector, and TU has been at the forefront of efforts, working with NGOs and governments. They aim for positive community impact, too, like donating 4 million food sets and COVID supplies since the pandemic began under their Thai Union Cares program. And in North America, they're implementing a GDI strategy, justice, equity, diversity, and inclusion, fostering a diverse and inclusive workplace. And in terms of governance, they have a dedicated Sustainability Development Committee. This isn't just a side project. It oversees sustainability for the entire group. It includes key business unit leaders, meets twice a year, and reports directly to the global leadership team and the CEO.
So it's got teeth, basically, integrated right at the top.
Exactly. It ensures sustainability is a strategic imperative, not just a compliance exercise.
That level of commitment sounds like it's being recognized externally, too. Do they have high ESG scores from third-party assessors? Those are increasingly important for investors, right?
They absolutely do. Thai Union consistently receives strong ESG scores from various reputable third-party assessors. For example, they score 64.29 from ESG Book, 41.00 from Moody's, 73.62 from Refinitiv, and a very high 85.00 from S&P. MSCI also gives them an A rating, which is considered very good. Furthermore, they are included in both the Statistic Index and the Dow Jones Sustainability Index, significant global benchmarks for sustainability-focused investments. They've also received anti-corruption certification, highlighting ethical business practices. These scores aren't just badges. They reflect external belief in their long-term efforts, which can mean lower cost of capital and broader investor appeal.
Okay, now let's shift perspective. Let's talk about the investor's view. After looking at all the operational and strategic details, what are analysts saying about Thai Union's stock? What's their outlook on its price?
We can look at Kingsford Research's analysis. Their latest update was May 13, 2068, so May 2025. They currently maintain a stock rating of accumulate buy for Thai Union.
Accumulate buy. What does that mean exactly in their terminology?
For Kingsford, an accumulate buy rating means that the fundamental price is expected to be 15% or more above the current market price. It indicates that, despite maybe some short-term headwinds, Kingsford sees significant upside potential in the stock from its current levels, suggesting it's attractive for long-term accumulation.
And what are their specific price targets for the near future?
Kingsford has set a target price for the year 2068 or 2025 at THB 12.80. Now, it's important to note this was actually a revision down from their previous target of THB 13.50.
Down from 13.50 to 12.80.
Okay, yeah. And the current market price for the stock at the time of their report was THB 10.4. So even with that downward revision, their target still implies a healthy potential upside from current levels.
Right. But what's the rationale behind Kingsford keeping the accumulate buy recommendation even while lowering their target price? That seems a bit contradictory at first glance. What's the nuance there?
It's a very nuanced view, you're right. It reflects both long-term optimism and short-term caution, which is pretty common in today's volatile markets. Kingsford maintains a long-term positive outlook on Thai Union's future. They see potential for significant value creation down the line. This is primarily driven by those ongoing transformation efforts we talked about, Project Tailwind, Strategy 2030, and the anticipated continued growth momentum in the higher-margin pet care and value-added segments. They believe these initiatives, once fully implemented, will enhance efficiency and profitability over time, driving long-term shareholder value. However, the downward revision of the target price reflects the high risks they anticipate for the current year. That tempers their immediate enthusiasm.
Okay, so what are those specific risks for this year?
Well, several significant factors. First, potential negative impacts from the Global Minimum Tax BEPS 2.0 Pillar 2. This aims for a 15% minimum tax rate globally for multinationals. For TU, whose rate has been lower, this could increase their tax burden, although as we noted, Q1 saw no impact yet. Second, they're weary of volatile tuna prices, which have trended upwards and can directly squeeze profits in their largest segment. Third, higher marketing, freight, and transformation costs are expected to weigh on earnings in the near term. The full benefits of the transformation aren't clearly visible yet. And finally, there's that persistent high uncertainty around U.S. customs tax policy, extremely significant given that 38% revenue exposure. Plus, the Q1 2068 normal profit and revenue came in lower than Kingsford's previous expectations, directly influencing their revised outlook for this year. So it's kind of a bet on the future, but with clear recognition of current headwinds.
Makes sense. So given all these factors, what are Kingsford's projected net profit figures for the coming years? What's their financial forecast look like?
Kingsford projects a net profit of THB 4,611 million for 2068. That would represent a 7.49% year-over-year decline, reflecting those short-term headwinds and increased costs. However, they forecast a significant rebound for 2069, projecting net profit of THB 5,192 million. That shows a positive 12.60% year-over-year growth. This aligns with their long-term positive outlook. It suggests that while this year might be challenging due to transformation and market volatility, they expect these efforts to pay off and drive stronger profitability next year, implying some patience might be needed from investors.
Are other analysts generally in agreement with Kingsford's accumulate buy in their target, or do we see different perspectives in the market? It's always good to get a range.
Yeah, while Kingsford has their view, it's worth noting other analysts might indeed have different perspectives, which is healthy for a market. For instance, Maybank Analysis has a hold recommendation for Thai Union and actually a higher target price of THB 14.70.
Hold at 14.70 versus accumulate buy at 12.80. Interesting.
Right. And Maybank's target, like Kingsford's, has also been reduced from a previous estimate. It's common for different firms to use varying valuation models, different assumptions about market conditions, raw material prices, or maybe the pace of the company's transformation. That naturally leads to differing price targets and recommendations. It gives investors a broader view of market sentiment and different expert opinions to consider.
Definitely. Before we move on to financial stability, could you quickly give us some key market data for Thai Union, things like market value and major shareholders? Just a quick snapshot.
Certainly. As of the latest reports, Thai Union's current market value stands at THB 46,333 million. The free float, the percentage of shares available for public trading, is 61.08%, which is pretty good liquidity. Regarding major shareholders, which can indicate institutional confidence or insider alignment, the top four are Thai NVDR Co., Ltd., holding 9.16%, Thai Union Group PCL itself, holding 7.26%. Those are treasury shares, which relates to the debt point we'll touch on. Mr. Thurafong Chansiri, a key individual stakeholder, with 5.94%. And Mitsubishi UFJ Morgan Stanley Securities Co., Ltd., holding 5.36%, gives you a sense of who the big players are.
Great, thanks. Now, a crucial aspect for many investors is financial health and dividend policy. How stable is Thai Union, particularly given the market pressures we've discussed? Let's start with their debt-to-equity ratio.
Okay. Thai Union's net debt-to-equity ratio as of Q1 2068 stood at 1.0x. This is generally considered a good level by financial analysts. What it means is the company's debt levels are roughly equivalent to its shareholder equity. It provides the company with sufficient flexibility for future investments and strategic moves without being overly leveraged. Signals a prudent approach to financing. However, it's important to acknowledge that this ratio did rise slightly from 0.94x at the end of 2067.
Okay, a slight increase. Why was that?
Primarily due to two strategic financial actions. First, their treasury share buyback program, where the company repurchases its own shares. This uses cash and impacts the equity side of the ratio. And second, they exercised a call option on perpetual debentures. Think of these as long-term, interest-only loans with no set maturity. Calling the option means they repaid them, which also use cash. Additionally, lower gross profit and higher SG&A expenses, as we discussed, also contributed by impacting their earnings base. But despite these factors, the company emphasizes that the 1.0x ratio remains at a satisfactory level and well within their comfort range for debt management. They also maintain a rigorous internal target for their net debt to EBITDA ratio of 3.54.0s, with a comfort level of 1.01.1x, further indicating their prudent approach.
Okay, so internally managed. What about their external creditworthiness? How do independent rating agencies view Thai Union's financial strength? That's often a key indicator.
Right. And Thai Union has maintained very strong external creditworthiness. Their long-term foreign currency debt rating has been maintained at A, with a stable outlook by Japan Credit Rating, or JCR, a leading Japanese agency. Now, what's truly fascinating here, and a very strong sign of confidence, is that this A rating is the same as Thailand's sovereign credit rating from JCR.
The same as the country's rating. Wow.
Exactly. It indicates incredibly strong confidence in Thai Union's financial standing and its ability to meet its long-term obligations, essentially seen as financially stable and reliable as the country itself by this agency. Their domestic currency debt rating also remains at A, with a stable outlook. The underlying reasons JCR highlights are the company's significant growth potential, particularly in those high-value segments, and its highly diversified global business operations, providing a robust and resilient foundation.
That's a very strong endorsement. And what about cash flow for the quarter? Was it positive, reflecting their operational activity?
Free cash flow, or FCF, for Q1 2068 was actually negative at THP $951 million.
Negative. Should investors be concerned?
Not necessarily in a single quarter, especially for a company undergoing significant transformation like Thai Union. It reflects the various investments and operational costs during the quarter, including that share buyback program and the debenture call option we just discussed, which are strategic uses of cash. For a company focused on long-term strategic growth and transformation, it's pretty common to see periods of negative free cash flow as they reinvest heavily in the business. In terms of their tax position, there is some positive news there. The full year 2068 effective tax rate is now expected to be lower than previously estimated. Crucially, there was no top-up tax impact in Q1 2068 from BEPS 2.0 Pillar 2, that global minimum tax initiative.
Right. The 15% minimum tax.
Exactly. This is significant because Kingsford, for example, had previously estimated Thai Union's effective tax rate would increase to maybe 12.50% because of this, up from their normal 7.9%. So this updated expectation of a lower rate for the full year with no immediate impact from the global minimum tax is a positive development for their profitability outlook. It reduces a potential headwind.
Okay. So, bringing it all together now, what's the general outlook on Thai Union's investment appeal and long-term stability? How should listeners weigh all these different factors we've discussed? It's a lot to take in.
It is. And when we consolidate everything, Thai Union presents a truly balanced and nuanced picture for investors, I think. Let's start by highlighting their core strengths and the positive aspects that underpin their long-term potential. First, their gross profit margin performance has been exceptionally strong, even setting that new record for Q1. This demonstrates disciplined cost control, effective raw material management, and a smart product mix strategy, really crucial in a tough market. Second, despite overall revenue declines, there's that vital underlying volume growth in key high-value segments like value-added products and pet food. This signals resilient demand for these specific categories and the success of their diversification. Third, their management has been incredibly proactive and strategic in navigating global challenges. Think about anticipating U.S. tariffs by building up 4 to 6 months of inventory. That's foresight. They're also smartly leveraging their diverse global production base, 15 facilities, 13 countries, giving them unparalleled flexibility to mitigate risks. Fourth, they've shown effective management of logistics, maintaining stable operations even amid global shipping disruptions like the Red Sea situation, which has hampered many others. Fifth, their financial stability is robust. That healthy debt-to-equity ratio, the strong A credit rating from JCR matching Thailand's sovereign rating, that signals strong financial health and prudent management. And lastly, their deep commitment to sustainability. Evidenced by the Blue Loan, strong ESG scores, certifications. This isn't just good PR. It's a strategic imperative aligning with long-term trends, opening new finance avenues, and appealing to conscious consumers. Positions them well.
Okay, those are compelling strengths and definitely show a robust company. But every investment comes with challenges and risks, especially in today's global economy. What should investors be aware of on that side of the ledger?
Absolutely. On the challenge and risk side, investors need to be aware of several factors. First, that overall decline in revenue and net profit when you strip away the one-time tax gain. It signals real underlying market pressures impacting core sales. Second, there's persistent soft demand in critical international markets like the US, Europe, and the Middle East. That continues to put pressure on sales volume. Third, they face fluctuating and sometimes rising raw material costs. Tuna, shrimp, salmon. These are volatile commodities, and price swings can significantly squeeze margins. Fourth, the negative impact of the strong Thai baht on financial translation continues to be a headwind, eroding the reported value of international sales. Fifth, they're incurring increased operational cost marketing to maintain share and those significant transformation efforts. Investments, yes, but they depress short-term earnings. Sixth, that persistent uncertainty around U.S. customs tariffs. It's a major risk, a geopolitical wildcard given their U.S. exposure. And finally, the benefits of the ongoing transformation initiatives, while promising long-term, might not fully materialize or be clearly visible within the current year. Requires patience. Oh, and despite the good Q1 news, the potential negative impact from the global minimum tax for the full year remains a consideration, even if it hasn't hit yet.
Right. So, given these strengths and these challenges, what does this all mean for the long term? How should listeners balance these factors when considering Thai Union?
Well, despite the immediate headwinds and some short-term volatility, the long-term view from analysts like Kingsford's Accumulate Buy remains largely positive. This outlook is fundamentally driven by Thai Union's strategic transformation efforts, Strategy 2030, and that anticipated continued growth in high-value segments like pet care and value-added. The company's strong financial foundation, its demonstrated operational resilience in a challenging global market, and its deep, externally validated commitment to sustainability all suggest a significant degree of resilience and potential for future growth. They are actively investing in making their business more agile and robust, even as they navigate this complex global economic landscape. As a final thought for you, the listener, maybe consider how Thai Union's proactive strategy inventory management, global diversification, might serve as a blueprint for other international food companies facing similar trade uncertainties. What stands out to you about their ability to adapt and strategically position themselves for long-term resilience in such a dynamic global market?
Finally, if you'd like us to cover any specific stock, just let us know. And please don't forget to follow, like, and share to support our team. Thank you.